Okay, let's get started. Thanks everybody for coming, fighting the traffic. I hope it wasn't too bad. I think from talking to people, it seems like most of you already know Melbourne Capital Group are working with one of our guys. If you don't, just very quickly about us, we do the structuring and the planning of people's wealth. And then we work with companies like GAM, who Julian is here from. They take care of the investment element of it. So Julian is going to talk about a fairly general global market update with a real focus on the US. We started planning this a little over a month ago. Probably a very different conversation a month ago. I think it's you can't even avoid it. It's in the news 3-4 times a day. Trump's done this, Trump's done that. So the last few days, I think he's had to make a few amendments to his presentation, but couldn't be a better time to talk about it, right? So yeah, I'll let him take away. This is Julian Howard. He works at GAM Investments, which is a Swiss asset management company, and he is their chief multi-asset investment strategist. So,
Great.
Julian.
Thank you very much, Mike, and thank you all for having me. As Mike said, I'm the Chief Multi-Asset Investment Strategist at GAM. We run about $18 billion for a wide variety of clients, including institutions, retail clients, high net worth individuals and wealth as well. The multi-asset team within GAM is the biggest investment unit at GAM, and we run just under $6 billion in multi-asset strategies, as the name suggests. That includes equities, fixed income and credit, bonds, and alternative investments. So we are quite well placed in terms of looking at what's going on in the market, because obviously we have to look at all the markets, not just equities, but bonds as well and alternatives. So our perspective, I would argue, is a little bit more unique, and we're more agnostic about markets as well. We are not, say, a European equity manager who is always going to talk up European equities. We are agnostic. We can go anywhere. We can overweight. We can underweight. So we see, how we see the world is how we invest, and I think that will hopefully make for an interesting perspective on what's going on at the moment, and which brings us on to the title of this Market Insights presentation, which is American Moment, question mark being the key point. Is this a pivotal moment for the US? The economy's already been doing quite well. Is it going to carry on doing well? If you think of the central base case scenario for Trump, it's tax cuts and deregulation, which should be good things for the economy. But does that come with inflation? Is there a risk of inflation there? And is the chaos going to get in the way? And is it going to dissuade investors? So we know what President Trump's opinion of this is. The golden age of America begins right now. So what we will do is have a look and see if we agree whether it's going to be a golden age or not. Also see what's going on outside America. Believe it or not, there is a world outside America. How we diversify portfolios also outside equities. There are bonds and alternatives, as I've mentioned. And then think about also, what is the structural case for stocks? What is the long-term case for investing? Because in our view, it transcends the now, it transcends what's going on right now. In the short term, markets are all about sentiment, but there are longer term drivers, economic growth, earnings, human ingenuity and innovation, which are actually quite reassuring things to lean on when you're opening the news every day and you see, oh my God, what's he said now? The gruesome video on Friday in the Oval Office. It can be very, very off-putting, but there are sort of reassuring long-term pillars that I think we can all lean on to try and transcend that. So let's get started. Oh, and the clicker has just chosen to fail. I did test it. Sorry.
Aim it, maybe?
No. Sorry about this. If we pull the dongle out and then back in again. Or else, Sav, I'll have to shout at you next slide. Sorry, slight technical hitch. I'm just waiting to be able to move the slide along. It was working a moment ago. Hang on. Click it.
It's working now.
Yep, got it. Right, okay, brilliant, thanks. Okay, there's a bit of text there. I'm not going to read out a whole bunch of text. I'm just going to give you a flavor of the 4 areas that we look at. The first thing is macro, what's happening to the growth picture at the moment. First thing to note, global economy is stagnating. So the world economy is not in a great place right now, but the difference is that the US is actually doing pretty well. So if you think of China, it's got this real estate overhang. Europe is stagnating, competition from China, doesn't have a technology sector, and it's got that reputation for low, anemic economic growth. Brussels, the global capital of regulation. So all those sort of bad things about Europe that you've heard are weighing heavily on its growth. The contrast is the States is doing well. Plentiful jobs, consumers are confident. This was even before Trump. Positive real wages, that's really important. So everyone can get a job, but real wages adjusted for inflation, that's positive, so they can afford things as well. And that's even before we get into the prospect of tax cuts and deregulation. Deregulation is quite important. The federal code of regulations is 100,000 pages long. Okay, so there's no way, whatever you say about Trump, there's no way that America is going to be as regulated now as it will be in 4 years' time. So that is something that will improve. You may not approve of the Doge's methods and the way they go about it. And I actually know personally 2 people who work at the EPA, and I'll just tell you now that people were sobbing in the corridors when Trump was elected. Okay, so the government is going to be shaken down and it's going to be brutal. But there's an argument to say that it probably got too bloated in the first place. But we'll come back to that. Ex-US, however, so that's the US, ex-US uninspiring, I've already hinted at this, low productivity, looking at you, Europe, demographics, looking at you, Europe, fragmented markets, Europe, and tariff losers, Europe, China as well. So very crudely, you can start to sort of paint a divergence between America on the one hand and this kind of stagnating ex-US economy. So that's the macro. What about markets, which is really what we're all interested in? It's a little bit subtler for markets. There have been 4 distinct equity eras since the pandemic in the S&P 500. Since September 2022, the S&P 500 has been on an absolute tear. The performance has been absolutely incredible. It's well over 60%. And that's far in excess of the 7% annualized number you would expect from American equities over the very long run. The problem with that is that valuations are stretched. The US market is not cheap. You've got the situation where artificial intelligence has driven up price expectation. And yes, Nvidia has done well, 70% revenue growth, 70% margin. It's a dream, it's incredible. But everybody knows this, and America is stretched as a result. And stretched valuations tend to mean lower future returns. A stock is basically a claim on a company's earnings streams into the future. And the more you pay up for that now, the less your future total return is. So that's one thing to bear in mind. Ex-US markets, yes, they suffer the headwinds that I've described, the growth and everything, but they're cheap. Europe is trading very, very cheaply compared to the US. China is trading really, really cheaply compared to the US. And if people are positioned bearishly, so they don't want anything to do with Europe or China, and things just improve a little bit in those markets, you get what's called an upward squeeze. And Europe's been outperforming America this year, which is actually quite a significant point. Europe has been outperforming America this year. And of course, we're probably going to have more defense spending in Europe, and that could boost growth. It boosted growth post-World War II and during the Reagan era also. So the equity picture is not necessarily exactly the same as the growth picture, just because of where valuation is. America, yeah, the economy's sound. It's an expensive market because everyone knows about it. Everyone knows about the artificial intelligence revolution. It's all very exciting. But you add in Trump, you add in the fact that it's stretched, and suddenly people are starting to look a little bit outside America. So that's just a flavor of markets overall. Final comment on markets. Even if Europe and China outperform, it's going to be very hard for global equities to do well if America is not doing well. And the reason for that, the MSCI All Countries World Index is 70% US. So if that tanks by, say, 5% over the next month or two, it doesn't matter if Europe and China together, which are about 15 to 20% of the index, it doesn't matter if they're up 10%, they're not going to offset the loss from 70% of the index going down 5%. The maths are just against it. So that's something to bear in mind also. It's all very well saying, hey, I'm diversified because I'm in Europe and China and it's okay, I'm avoiding America. You can't avoid America. You can't really avoid it. So America still has to do well over time for investors generally to get the growth they need. I've got some reassuring points about that at the end, which I'll come to. The third category, capital preservation, what do I mean by that? That's really diversification. What happens if stocks tank? The whole point of multi-asset investing and the whole point of the portfolios that you're accessing through Melbourne Capital is that they're multi-asset and they diversify so that when stocks go badly wrong, and they do in the short term sometimes, the other part of the portfolio is doing more heavy lifting for you. And the idea is that that other part, bonds, alternatives, doesn't go wrong at the same time, because that's a disaster. What it needs to do is be consistent. So you can accept equity volatility as long as the other components of your portfolio are doing okay. And you think, hey, this isn't so bad. Stocks are down 10, but guess what? I'm only down 5 because I've got the other components that are working well. So what's happening in diversification world, one thing that's changed that's making life harder, long-dated government bonds, sounds very boring, but if you think to the classic 60-40 portfolio, 60% equities, 40% government bonds, that 40% government bonds, particularly US Treasuries, have actually been performing really badly since 2022 because of inflation, primarily because of inflation. That's quite bad news. It's making diversification harder because you can't just lazily allocate to government bonds and think, hey, they'll bail me out. Because what if you get in a situation where stocks go down and government bonds go down? And that's what happened in 2022. That's why it was such a disastrous year for multi-asset investing, because a lot of multi-asset investors, not only do they have the stocks, but they will have put their clients into a lot of government bonds thinking, hey, this usually works. It's a great offset. And then it didn't work. Similar thing happened in 2008 as well. And it's the nightmare scenario that we at GAM work very hard to avoid. You don't want to get into those longer dated government bonds. And the good news is there are lots of other things to do. Short dated bonds in America, the 6-month Treasury bill is yielding over 4%. And it only has 6 months of maturity. That's incredible. You can get 4% on an annualized basis from that short dated bond. And there's no maturity risk. It doesn't really go up or down with inflation. If you hold it for 6 months, you will get half of that 4%. And if you roll on to the next one, then you get the full 4%. So that's just one idea. There's gold as well, which has been doing well. I think I was speaking to one of you about gold over time. That diversifies very, very nicely. So the good news is there are things out there which we've identified, we've researched, that will work, that will continue to work. And then the final point on this diversification, I promise you this is the last slide with lots of words on it, simplicity and transparency. They tend to prevail over the sophistication that peer groups reflect. What do I mean by that? There's a lot of excess sophistication and complexity in the investment management industry. Usually because, I should be careful what I say here, but usually because investment managers want to justify fees. We try and keep it very, very simple. There is no premium on complexity in investing that we have identified. There is no obvious premium on complexity. So our portfolios tend to be very straightforward, very transparent, almost disarmingly so, because the important thing is that they work over time. As I've said, that non-equity sleeve needs to work for you if things are volatile. The US market has been volatile in the last few days. You're not going to be rescued by Europe, although it's helpful to have a Europe allocation in equities, but really what's going to get you through it is the diversifiers, short-dated bonds, for example, gold, maybe a bit of listed real estate, other areas like that, which need to step up. So that's a crucial component. Yes, please.
First of all, do you mind questions during?
I don't mind questions during. I will answer them quite briefly, though, to keep up the flow, but please do ask.
No, I mean, the dollar is the world's reserve currency, but most of us actually don't live in the dollar world. We live in ringgit world or sterling world. That's one or two, maybe exceptions. So surely exchange rate is forex. Is really important.
Yes,
Well.
it's a very important aspect of return, the currency. If you're holding dollar assets and you're not hedged, the dollar has done pretty well against emerging market currencies, done well against the pound as well recently. So when tariffs get announced, the dollar tends to do well. It's been a little bit weaker just the last few days, but generally the dollar has been a beneficiary. It's been a tailwind as long as you're not hedging back to the dollar. So yeah, we'll come to the dollar in a minute, but you're right, that is a component. Currencies, I'll just say one thing on currencies. There's very little academic literature to support the fact that trading currencies can add value. Very unpredictable on the whole to trade them. So that's diversification. Last point, risks to watch. This is the juicy bit. Trumpism is nothing if not inflationary. So deportations of undocumented migrants, of whom there are 11 million in America, of whom nearly 9 million are working in the economy. Imagine what happens if you get rid of them all. That's going to be inflationary for wages. Tariffs announced on Mexico, Canada, another 10% on China as well. Inflationary for US consumers. So Kamala Harris, remember her? She actually said this is going to be like a tax rise. This is going to hit people pretty hard. And then tax cuts as well. These are all signature policies, but the American economy, as I've said at the beginning, already doing quite well. So what happens if you throw in all this extra stimulus to it, deregulation, tax cuts, then you start deporting, then you start adding tariffs, then you've got a bit of an inflation issue. So that's the main risk to watch. And the further risk is what happens if there's inflation? What does the Federal Reserve do? It has to ramp up interest rates because its mandate is to keep inflation below 2%. And I'll tell you right now, it's at 3%. And that's it before the tariffs really start to take effect, before the tax cuts have been renewed, before the deportations have started, and we're not even there yet. So investor positioning also leaves little room for error. Everyone loves America at the moment. I've got a chart to show that. People are positioned long American stocks. So there's no room for error. If anything goes wrong with the narrative being tax cuts, deregulation, make America great again, if something goes wrong with that, the inflation that I've talked about, the general chaos that seems to be going on, literally from 1 hour to the next. What if the growth doesn't come through? That risks retail investors panicking and coming out of US equities. And we've seen that US equities haven't been performing well in the last few days. They've been very rocky. And year to date as well, American equities have underperformed European equities. Final point before we get to the pictures. Amid elevated uncertainty, it's vital to acknowledge the basic structural case for stocks. That's just a fancy way of saying stocks are a way of monetizing human ingenuity and innovation. So whatever happens in the short term, stocks basically give you a return based on humanity's progress. And that's the base case for stocks. That is the reason we have it in multi-asset portfolios. So when you think about what are my growth objectives over time, what do I want to achieve with my investments, the starting point is, okay, well, stocks over time have delivered between 6.5% to 7% in real terms. That's almost your founding principle. And then, depending on your landing zone, retirement, or whatever it might be, you then diversify your stock allocation so that you remove the bounciness out of it. But I think that's a reassuring point. The basic structural case for stocks is undimmed. No matter what Trump does, no matter how badly the Chinese economy goes, there's still a basic structural case for stocks, which I don't think has changed much. Right, onto some slides. I'll go on to this slide. So this chart is showing US economic growth prospects for 2025, for this year. And it's the evolution of those growth prospects for all the different economies. So Bloomberg interviews a bunch of economists, says, how do you think the world economy is going to fare? And you can see from about Q4 24, the economists all started uprating American growth for 2025. Now, by contrast, they all started downgrading Eurozone growth, UK growth, we'll talk about the UK in a minute, I'm sure you'll enjoy that, and also world growth. So America is standing out as the one economy whose growth prospects are being upgraded versus the rest of the world. So it's just to make that point. The US economy is still in a good place as of now. Potentially there's going to be some confusing factors and some risks, as we've discussed, but that's the basic backdrop. And America also has some intrinsic economic advantages. One is productivity. It's a more productive economy than the rest of the world, and that's partly because of the technology sector. I've got a quote here from The Economist which explains this. American workers have more tools at their disposal, the physical kind such as highways and warehouses, and the intangible sort in the form of software. And if you look at labor productivity, so that's how productive are workers per hour worked, per person working, and you rebase it to 1999, there's a cavernous gap there between America and the rest. And it's because of the way, partly because of the way they integrate technology into their working practices, and also better quality management as well. Americans are the best corporate managers in the world, according to various surveys and academic literature. Interestingly, Britain's ranked about 9th in terms of management quality, in case you were interested. So that's America's productivity edge. So I'm going to very quickly look at the rest of the world. Obviously, I'm not going to have a slide for every single country, but just a couple of highlights. China's bond market signals economic hopelessness. What do I mean by that? This is the Chinese 10-year and 2-year bond yield. The easiest way to understand the bond yield is as a predictor of future inflation and growth, right? Now, both of those have tanked, whether it's over the 2-year or 10-year period. So bond investors have very, very little faith that China's economy is going to improve. I think China's inflation data is coming out this week, in fact, and they are heading for deflation. And deflation is a disaster, because if you have a deflation scenario, consumers don't spend money, because if they think that flat screen TV is going to be cheaper in 6 months, they will wait 6 months to buy it. So it delays purchases and it hits the economy really, really hard. And China is trying to change its economy from export-led to consumption, more like America's. And deflation is a mortal threat to that. So Bloomberg Opinion have said in January, yields are in a perpetual slide, far from what should happen with a big stimulus. So the government, the authorities in China have tried to inject money into the economy. They've tried to sort out the real estate crisis, but the bond market is having none of it. It's rating growth and inflation very low. Yes?
We see a lot of news about innovation in China.
Yeah.
In terms of technology.
And I will come to that. It's the one bright spot in China. So Chinese technology stocks have actually done quite well this year, but Chinese technology alone cannot solve all of the problems. Interestingly, Jack Ma was at a business symposium, I think at the end of February, so he's sort of been rehabilitated Soviet style. They have brought him back into the fold, but it's been made very clear, you can all come back, but you've got to obey the rules. And I think it's the authorities really signaling, we're going to need the private sector's help here, because we can't do this on our own. We have a major growth problem. And for China's sort of security and social unrest, they have to keep the economy growing. That is absolutely key. You've got to keep people employed of everywhere, but particularly add in the paranoia of, we won't go there, but you know what I mean, that it's particularly important in a regime like that. The UK, right, this is the UK, the fun part. Just as an example of another economy that is looking very, very different to America. So I know some of you are expats from the UK, so I think you'll enjoy this, and it will sort of almost confirm your decision not to live in the UK. But this is sterling dollar from 1900, as if you needed confirming of that decision. This is cable from 1900, nearly $5 to the pound in 1900. Today, 1.3. So successive disasters, World War I, World War II, where we were apparently the victors, squandering of Marshall aid, Brexit, the list just goes on and on and on of all these kind of self-inflicted economic mismanagement. And I think that's really gives some context to what's happening today in Britain. We've got very, very low growth. The fiscal position is appalling. The tax burden is high. Services are broken. I mean, you can see the degradation around the country in terms of the roads, everything. The hospitals barely functioning. And it's just, again, it's another example of an ex-US economy that is tanking and whose prospects look relatively bleak. Now, might that change with more defense spending? I think I alluded to Europe spending a bit more on defense and that kickstarting the economy after the Second World War during the Reagan era. Yeah, possibly. But the point is there is a very long context to this. What's happening in Britain now is not news. It's part of a very, very long trend. And to your point on currency, if you have a UK portfolio, UK denominated portfolio, and you've been investing in America, that has been a massive tailwind. So this whole period, if you've held US stocks, which most Brits don't, certainly over the last few decades, there's tended to be home bias, FTSE 100, gilts, and I think a lot of investors think like that. They have their home markets that they tend to invest in, but that means you lose out on the US, the technology boom, and also the currency, the fact the dollar is so strong. So that's the final one on the macro economy. We'll look at equities now. It's a bit of a Taylor Swift joke. My daughter's very much into Taylor Swift. She's just on the Eras tour. So if we look at the S&P 500, and we split the period from 2020 into 4 distinct eras. Working remotely, and we've rebased it. So working remotely was from January 2020 to the 8th of November 2020, because on the 9th of November, Pfizer announced their vaccine, so that you could argue that was the end of that initial kind of panic. You see the pandemic there, and then it sort of started to recover. Second era, reopening, Pfizer vaccine announced, economy slowly starts to reopen. That did really well. Third era, inflation surprise. So I think I talked about 2022 where nothing worked. Equities were down, bonds were down, inflation went up, Ukraine was invaded, couldn't get chips for cars. Do you remember semiconductor shortages, supply chain disruption? And then fourth era, which is now nearly 600 days old, from the 13th of October 22, what happened on that day? It was the first day that US headline inflation started to come down after getting to nearly 10% post-pandemic. So this has been an incredible, nearly 2-year, more than 2-year era for US stocks. And it's just to provide a bit of context. It's been an amazing run in US stocks. And it's, if you're thinking, well, I better join now, it's less obvious now than it was 2 years ago. Valuations are more stretched. This is, you might be familiar with price earnings ratio. How much price are you paying for a given amount of earnings? This is what the blue line is showing. The US equity market is nearly at 38 times earnings. So you're paying 38 times more price than earnings. That's expensive because everything I've talked about, everybody knows about. Artificial intelligence, everyone knows about that. Deregulation, tax cuts, everyone knows about that. So the market is as expensive as it was post-pandemic. It was nearly as expensive as it was during the technology boom of the late 1990s. So this is not a cheap market anymore. And this is the problem. You've got a good economy, but the market is not cheap. What's the grey line? The grey line is what happens to the S&P 500 over the next 5 years. So I've interlaid it on top of valuation. What I'm basically saying is the more you pay for stocks, the lower the subsequent return. The less you pay for stocks, the higher the subsequent return, because it's inverted. So today, the implication is that actually US stocks over the next 5 years are going to give you 0 because they're so expensive. So what has to happen? Either there needs to be more speculation and people carry on buying them without earnings changing, or American corporate earnings need to start accelerating again from here. And maybe that can happen. Maybe Nvidia can keep surprising the market. That is possible. But it's a risk that we're looking at quite carefully at GAM. The reassuring point is that corporate earnings are related to the economy. So this blue line up and down is a leading economic indicator for the US. It looks at consumer sales, consumer expectations, house building permits. It's an amalgamation of it's like the heartbeat of the US economy. And it's actually doing quite well. The US economy is picking up quite nicely. And earnings, the S&P 500 earnings are related to that. So again, that's reassuring. Yes, the market's expensive, but it needn't tank from here. It needn't blow up because the underlying economy, which feeds company earnings ultimately, is doing okay. So that's a reassuring point. Now, DeepSeek. What about DeepSeek and what its effect is on artificial intelligence? This is the 27th of January when DeepSeek was announced to the market, minutes since trading opened on the US stock exchange. And I've shown 3 different stocks here: Apple, Taiwan Semiconductor, Nvidia. Apple actually did okay, the other 2 less so. Now the reason for that, and the reason not to worry about DeepSeek, bear with me, is something called Jevons paradox. Jevons paradox says that when there's a technological breakthrough, what happens is that demand for that technology increases. So you don't lose, you actually gain. So if you think of lighting, I think some of you probably heard my lighting analogy earlier. If you think of a Babylonian oil lamp gave 0.01 lumens of light, an LED light gives 350. So the effect of that transformation is not that we just have the same amount of light, but hey, it's much cheaper, isn't that great? No, we're using tons more light now. And it's the same with artificial intelligence. And the reason Apple outperformed is because Apple sells endpoints. And by endpoints, I mean phones, earbuds, laptops. If you can lower the cost of AI, you can get that AI intelligence into things very, very cheaply without using up loads of power. There's only so much power a laptop can draw on. But if you can get AI, and DeepSeek has done this much more efficiently, get it to answer your questions more efficiently because the model consumes less power, that's going to increase aggregate demand. So I don't know if any of you remember, Apple Intelligence was launched in November. It was Apple's AI, but you could only get it on iPhone 16 and above. So it was like a special thing because you've got to have the really good iPhone to get it. Breakthroughs like this mean that everybody will be able to get it. That's really, really significant. So there's no reason Microsoft should lose out because aggregate demand will go up. NVIDIA shouldn't lose out either because overall demand will go up. And the Microsoft CEO, Satya Nadella, I mean, in a way, yes, he would say this, wouldn't he? But I think it was a good point. Jevons paradox strikes again. As AI gets more efficient, we will see its use skyrocket. So I'm not really worried about AI being some kind of disaster that is going to tank the US market because the Chinese will come up with something cheaper. I think AI demand will skyrocket and the US will continue to benefit from that.
Would an NVIDIA investor agree with you? Right?
Well,
They can do it in a manner that uses small chips.
yes, well, potentially, but NVIDIA is continuing to benefit from enormous levels of investment from Alphabet and from other companies. So it's not clear yet that there will be no need for high-powered chips because the DeepSeek model is not quite as sophisticated as some of the others.
Good enough.
It's pretty good, and if you own a BYD,
Which is the one that usually
I don't disagree on that point. If you own a BYD, they've released a software package called God's Eye, which will load in autonomous driving based on the DeepSeek model, and that is going to be as transformative as the seatbelt and the airbag. So there is a case for, yes, the cheaper model will democratize and will spread it everywhere, but there's no sign of the big US tech firms lowering their investment spend. They still feel there is going to be need for these data centers for the high quality models. We'll see. I think the point I'm making is there's no immediate need to panic yet, is what I'm trying to say. Right, that's America. What about outside America in terms of the stock market? This is ratio of forward PEs over US. What do I mean by that? How cheap are these other markets relative to the US? So 0.6 means, that's for Europe, means Europe is trading 40% cheaper than America. So all of these ex-US markets are trading between 40 to 50% cheaper than the States. The question then becomes, is it a sweet shop or is it a box of tricks? That's the question for investors. At the moment, we've actually lifted our European equity allocation to a kind of more neutral level, so we're sort of sitting on the fence. We don't hate Europe, we don't love it yet, but there's clearly something there. It is attractive on a valuation basis, but the criticism of Europe is quite easy to make. So at Davos, Larry Fink challenged ECB President Lagarde and said, Europe's over, isn't it? The place is screwed. And the need to even defend this was extraordinary. Europe is not a myth. Europe is not a basket case. Isn't it amazing that she even has to say that? So that's something that we have to assess. And our instinct is at the moment that, yeah, Europe is a bit more interesting. The US is vulnerable because it's quite fully positioned. People are fully positioned into it. And anything goes wrong, you're going to see more volatility. So I think it's worth making a cautious entry into Europe. You've got the defense spending argument as well. So we're kind of leaning towards sweet shop, but we're not all in either. But one thing you can't refute is it's a heck of a lot cheaper than America, relatively. You are buying these markets at a discount.
Sorry, what's your definition of sweet shop?
Oh, so
Horizon thing, is it?
yeah, well, sweet shop is will it rally and start to do really well? Box of tricks is it cheap because it's crap, effectively. So is it a value trap, or in fact is it really cheap and no one's really realized it? And if I get it now, there'll be a price discovery and suddenly it will rocket. And that's what started to happen this year. Europe has started to outperform the US. Right, diversification. So I'm about to 3/4 of the way through, I think. Government bonds have been a source of volatility. Now, this is the point I was making, that outside equities, you've got to diversify. In multi-asset, you have to diversify. That's where you have these other asset classes. The problem has been, this is 10-year government bond yields. They've actually been going up since August. The reason for that is there's intellectual disagreement in the bond market about what's happening with inflation. particularly around US inflation. Will US inflation go up or not? And there isn't consensus on that. And bond yields have been going up because bond investors have said, well, we're not sure, so we're going to start demanding more yield if you want us to lend to the US government, because inflation may go up, it's looking inflationary, so let's start pushing bond yields up and prices start to go down. That's not good if you hold it as a diversifier against equities. So any period here where equities went down, you would have had bond yields going up and price going down as well. So we're trying to avoid government bond yields because they're very sensitive to changes of expectation around inflation in America. And this is part of a bigger problem when we're building portfolios, in that this chart is showing the correlation, the relationship, let's say, between US stocks and US bonds. So one being they're moving exactly the same, and -1 is they're moving in opposite directions. So when you build a portfolio, you want to put assets in that do different things. You don't want everything moving in the same direction at the same time. You need the diversification. And what's been happening is that you've got bonds starting to move in the same direction as equities. And that makes life very, very tough for multi-asset investors. Hence the quote, the most important concept in modern finance, brackets diversification, has become maddeningly hard to implement because of government bonds behaving badly at the same time as equities. But as I said, there are other things we can do. For example, gold is one of them. I was talking to one of you about gold. If you look at the gold price over time, this has proved to be quite a nice hedge against US economic policy uncertainty. What is that index? Literally, it's an index based on scouring the media for the words policy and uncertainty, and it spikes up during periods of turbulence, global financial crisis, the debt ceiling drama in the US, Trump 1, COVID, Trump 2, but gold has actually been quite a nice diversifier through those periods of crisis. So it's something that we hold, not in a large amount, but it's something that's very helpful for diversifying portfolios, more helpful than government bonds have been in the last few years. So gold increasingly effective in hedging unknowns, and there are a lot of unknowns at the moment. So investors, yes?
Now at this point, I have to say this. The scales you present are quite different, because the first slide you put about the bonds was 6 months or 8 months. And
Yes.
then this one is 30 years.
Yeah.
So it's a bit of a...
A duration mismatch. I can assure you gold's been doing well over 6 months as well. Yeah. Well, I think the point I'm making is that because we didn't always hold gold, it's something that's becoming increasingly reliable. So actually, this goes back quite a long time to 99. It's not a million mark. It's still quite long term, to be fair. But I take your point. But the bond problem really only started in the last few years. But you could make the case that gold has become more effective in the last 20 years. So yeah, it's been something that's developing. I think that's a fair comment. Right, last point on diversification. These are the yields on offer from all the main asset classes. So the iShares Global REIT, Real Estate Investment Trust, 3.5% dividend yield from a diversified real estate investment trust. The S&P 500 earnings yield, 3.7%. That's not much for basically taking on equity risk. 3-month Treasury bill, 4%. And you'll see why it's in the box in a minute. 10-year Treasury, 4.4. But remember, 10-year Treasury, that can move around a lot. You know, yields have been spiking up. That's not, 10-year Treasury is not your friend at the moment. Investment grade, so high quality corporate bonds, think Coca-Cola, Pfizer, 5%, 5.4%. Okay, that's not too bad, but you are investing in companies and they're potentially a bit more volatile. They could default. Junk bonds, so that's kind of companies that are fairly near default, maybe struggling a bit. Yeah, you get 7%, but if anything goes wrong with the economy, that gets wiped out very, very quickly. So the winner, in a way, and by the way, we're not going to invest 100% in this, but we're using it a fair amount, is the very short-dated government paper. In the UK and the US, you can get around 4%. Eurozone, it's a bit less, but if you think about it, there's no risk associated with it. You're not holding it long-term. You can roll, after 3 months, you can roll it over again, and the yield is pretty good. You're not taking directional risk in the way that you are with the 10-year Treasury. You're certainly not taking the risk you are with the S&P 500 at the moment. Yes?
Is that where Berkshire Hathaway's put his 300?
Yeah, well, cash, yes. They're holding a lot of cash, partly in T-bills, yeah. Yeah, because you can get 4%. US money markets have exploded. I mean, a lot of investors are in US money markets at the moment because of that incredible yield you're getting with no risk. But at the same time, retail investors are also in the S&P 500. I'll move on to risks now. Inflation, I think I've talked about this. This is US headline inflation, so including food and energy. It's at 3%. That's significant because the Fed's target is to get inflation below 2%. So it's running above target, and that's before tariffs have really taken effect. It's before the deportations have started. It's before the tax cuts have been renewed. Okay? So that's definitely a risk if inflation goes up. And it never really died after the pandemic. So there's a sort of joke that it's a bit like cockroaches. You've got to kill all of them. You can't leave one or two scurrying around, because then they start to populate again and expectations start to rise. And then once people start thinking prices will rise, it becomes a self-fulfilling prophecy. So that remains a risk at this point. And I think it's a particularly Trumpian risk. Now, there's one interesting offset. I won't spend too long on this, is that Trump has also been leaning on OPEC to release oil supply. So I think he and his advisors know that what they're up to is potentially inflationary, and he's been quietly leaning on OPEC to release oil supply and lower the oil price. So crude oil is now under $70. It was about $80 at the start of the year. And it's also part of the more public drill baby drill mantra as well, though he directs that more at US drillers. But that's just an aside. I still think inflation is the main risk from this administration. This chart looks a bit weird, but what it's showing what the futures market is predicting for US interest rates. And the futures market is predicting, if you think interest rates are there now, it's predicting by the 27th of January 2027, cuts to about 3.7%. So not much. The futures market no longer thinks the Fed is going to cut rates. And I think we can be bolder. I think we could argue that it's not going to cut rates at all. And I think there's even conversations happening about the Fed increasing rates to deal with the inflation that we're seeing. Now, Trump is leaning on Jay Powell, the Fed chair, saying rates need to come down a lot. So Jay Powell needs to think, do I take my mandate literally, and as I see inflation coming out, do I just ramp up interest rates and just kill the economy in the process? Or do I maybe not do that, because if I do that, maybe Trump will kill central bank independence and kill the Fed's independence. So it's quite existential what's happening, and that will have major ramifications. If the Federal Reserve gets neutered because of this, that could be very, very seismic for markets.
Is it possible?
There are ways to do it through the Treasury. There are ways that he can, and through executive order, and he's already leaning on Powell a lot. So there are ways he can do it. And any threat to the Fed independence just reduces the credibility of America as well. So it's a problem.
Could I just ask, at this point in time, that's the Fed's thing, it's 4 points? 4 point,
Yeah, I think this is the mid-range,
so
because there is a bound. There's a
Americans do these mortgages at 30 years.
yes, fixed
And
rate
Americans
mortgages.
are fixing it at
So a lot of them aren't
8%.
affected. It's absolutely right. A lot of them,
Many are much lower than that.
yes,
But youngsters now, they're dealing with 8 to 30 years.
yes. So a lot of Americans aren't affected because they fixed previously at lower rates.
Now,
So yeah, so the effect would be now on people who are now taking out a mortgage. If rates go up, they're not going to do it. Yeah, it's definitely a risk to the economy. But it hasn't. Yeah, it's not as pronounced as it was previously. But as people start to buy houses again, and if rates go up, that will be problematic. Because if you're not moving house, you're not spending money to put things in the house as well. So that's again not good for consumption. And of course, America is 80% consumption. Yeah, exactly. Other risk, anything unexpected from here could upset investors. This chart is showing the Conference Board Consumer Expectations Survey 12 months ahead. So they ask American consumers, how many of you do you think, how many do you think stock prices will increase? Answer at the end of January, 53%. That is actually a record since 1989. 53% of respondents felt that the market was going to go up over the next 12 months. How many think will prices will decrease, 23.7, not quite a record, but you can just see from the visual how priced for perfection that US market is. You know, people are positioned in that market. If something goes wrong with the narrative, if something happens, suddenly they'll be scrambling to exit because they're expecting perfection. And that's always dangerous.
Sorry, Julian.
Yes?
Is 52.9% also the number of people who voted Trump?
Yeah, they tend to be more optimistic because they've got their man. They've got their man in office. So there is something to do to that. And actually, the conference board also looks at Democrat versus Republican optimism. So Democrats, understandably, at the moment, are really depressed about inflation. You know, Republicans are not because they're
The number who actually voted.
yeah. Yes, of the number who voted.
But
That's
if
true.
Trump is really isolating US because with the tariffs and with Putin getting friendly, he's really going to put a lot of the rest of the world against him. Can the economy, I mean, still perform decently?
I think so, because you've got 350 million people and there's no friction to trade within that block. So it's not like the European Union, which is actually in reality quite fragmented, more fragmented than you think. You can't sell, it's not so easy to set up funds in one part of the EU and then sell them in Italy. It's not as smooth as you'd think it would be. Mario Draghi wrote a paper in September called The Future of European Competitiveness. And if you want to know what's wrong with Europe, just read the synopsis of that. So no one's written a paper on the future of US competitiveness because it's sort of self-evident. But I think the American economy has a fundamental strength that will carry it through. And we'll come to, there's a slide showing that in a moment. But my point here is that anything that goes wrong could upset investors. And one thing that is going wrong right now is the sequencing of the Trump program. This is something called the ISM Manufacturing PMI. It's another barometer of economic health in the US. Now, this is the first Trump term. The first thing he did was the tax cuts. He did the tariffs afterwards. So the difference this time is he's done the bad stuff first, and he's doing the bad stuff first, and he hasn't come around to the tax cut renewal. So already that's creating more volatility. In the first term, the Tax Cuts and Jobs Act came through first, and that gave investors a lot of confidence. And then the tariffs came later, and they weren't as onerous as what's being proposed and being done right now. So again, the growth that everyone expects could be somewhat delayed. That's a risk. This is my final chart, and this is the reassuring chart, and it speaks to the point about growth. This is showing 10-year annualized returns from the US over the last 100 years. The long-run return in America, the kind of long-term average for US stocks, has been 7.4%. For bonds, it has been 2.2%. So the founder of GAM, Gilbert de Botton, in the 80s always said, you're either an investor or a lender. And if you're an investor, that's 7.4% at long-run rate of return realized from US stocks. That is something that you can rely on over time, and it transcends what's happening in the short term. Now, Jeremy Siegel wrote the Bible of buy and hold, a book called Stocks for the Long Run, and I would actually recommend, because I saw the little library shelf at Melbourne Capital at the entrance. So I would say you could add this book to your little library. It's called Stocks for the Long Run. I think it's in its 6th edition or so. And he observed that actually over time, American stock market has produced a return of 6.5% to 7% over time. And he made the point last year, yeah, you have a bad year or two, and maybe we're going to get into a bad year, but then we're in a reversion to a long-term trend line. That's astounding. And I think it is astounding. It's that enduring power of stocks over time that I think gives some reassurance, and it kind of transcends what's happening in the short term, because it's very easy to get upset about Trump. Oh, look what he said now. This is just such a disaster. But America's seen all of this. This return is net of World War I, World War II, the Great Depression. It's net of all that bad stuff. That's what you get after taking into account all that bad stuff. So whatever Trump does, my sense is that in 10 years, that observed rate of return, it's a bit like Moore's law is for chips, you double every however many years it is. It's a similar thing. It's not a law of nature, but it's an observation. My bet is that over the next 10 years, we'll still be talking about the Siegel constant, which is that observation that stocks will give 6.5 to 7% annualized return over time. And I think with that, I'm happy to conclude because it's a sort of note of hope, not despair, but it's going to be very important in our conversation with clients, looking at this long-term structural case for equities and not getting into too much of a twist about what's happening in the short term.
Julian, it seems to me the area under the 7.4 is about the same as the area above the 7.4, right? Give or take.
Yes.
But we have to recognise is say if you start with 100, figure of 100, and loses 10%, goes down to 90, and then gains 10%.
It's not 10, yes, it's not the same mathematically
It's actually less.
on the other side. Yeah.
You actually lost over a long term.
Yeah.
So is this annualized or what is it?
Yes, this is annualized return. It's actually 10-year annualized returns.
10 years.
So each spot is what's happened over the last 10 years,
Okay.
effectively. So the number has come out a little bit higher than the Siegel constant. So the Siegel constant is about 6.5 to 7%.
Yeah.
And that is really the monetization rate of human progress, if you like. And it doesn't matter what Trump does, that number I don't think will be affected negatively over the next 5 to 10 years. And I think that's the horizon you need to think about, in holding stocks.
Well,
effectively.
that may be true for a lot of people. For me, I retired 2 years ago. I don't think 10 years forward.
Right.
I think
Then it's then it's a suitability
different.
Yes, then it's a suitability conversation. How much stocks should you be holding? And maybe actually a defensive portfolio with like 30% stocks and then all the diversifiers that I've talked about, that's probably more suitable.
Thank you.
Yeah. No, that's a sort of almost a different thing. So there's suitability and then there's the enduring role of stocks. But you can assume whether it's a defensive, a balanced, or an aggressive portfolio, you kind of base that, your return assumption is kind of 6.5 to 7%, but with the caveat that sometimes you can get a whole year or two can just be wiped out. 2022 being a classic example.
I took 2 points from you, and I'd like you to validate if I understood correctly. Is that right now it's maybe a little bit expensive, and it might not be a good idea at this time to invest more in the US market, but whatever you have for the long term is relatively in a good place, and there's no need to do.
I would say so, yeah. I would say so. But there's always a little bit of risk management that can be done over the short term. We've taken a little bit out of US equities, but we're never going to really bet against America in a meaningful way, but because it's just got that whole supply side, it's got all those good things going for it. It's just a bit frothy right now. It's expensive, and Trump is adding to the chaos. So given the fact that we've had this incredible run since 2022, taking a little bit off the table, maybe reallocating a little bit to Europe and maybe China, I don't think that's crazy. I don't think that's too controversial. But would we get rid of our structural allocation to American stocks? No, because I think the case remains undimmed. It remains very, very strong. So hopefully that leaves things on a slightly more cheerful than depressing note, given all the news.
Sorry, in the short term, would you go more European than American?
Yeah, in the short term, I think there's probably a bit of a tactical case to be made, and China as well.
Can you go back to the currency chart you showed? US dollar versus
Versus sterling.
Yeah.
Of course.
It's just a downward trend.
No, well, I think it's forward one.
Hang on. Yeah, it is. It just got stuck.
You could argue since the last 40 years, since 1985, it's been stable. 85?
Yeah.
1.3?
Yes, from that dip
Yes.
in '85, arguably. Well, then it's recovered, and
I mean,
you could possibly, yeah, if that was your. Listen, there's always going to be points. There will always be points on the chart where it doesn't work, and you could also argue if you bought American stocks in March 19. What was the exact date? March 2000, wasn't it? Was the peak, or was it 2001? March 2000. Yeah, if you bought it right then. I mean, we had a Spanish client who had the IBEX, and he bought it at the peak of the technology boom. 10 years later, he said, I still haven't made any money. So there is an element to, yes, so there is an element of market timing.
I really do believe that past performance is no indicator of future performance. And if we'd had this talk 15 years ago in 2010, you'd saying we're picking points on the chart. We have to be careful.
That is true,
has
but
been
knowing
going
what
on
we
for
know
years-
about the UK economy and how it's being
I'm
managed,
not
the
supporting
productivity challenge, then
not
I think
supporting it, I'm
it's
just
not
saying.
unreasonable to say that this is part of you could argue maybe our rate of decline has slowed relative to America's. I think there's probably something in that the big drops, perhaps behind us. But Brexit, that was another drop there. The GF's the global financial crisis, which in some ways the UK never really recovered from.
One thing I'd just like to get your view on is that for many of us who are going through this period, like Fridays, etc., the chaos of elections in the last few years, the credibility of America stepping in and out of the climate change risks, most people are very concerned about, is that by year, Americans are losing complete respect of absolutely everyone on the planet, right? And it's a
Well,
bit
not
like
all
that.
Americans. Not my friends at the EPA.
Yeah, no, there are lots of Americans, and I would say the majority of Americans, because 33% of people in any elected any Democrat like Australia or any Anglo-Saxon reception, 30% are apathetic, 30% not that way, and 33% the other way. When you force the 33% who are apathetic to do things, just in Australia, half got one way, half got the other way. So democracy's got a problem. Now, what you have in Brexit was one of the dumbest things that was ever done. Not to put a 2/3 or at least 80% or 70%. Swiss did it.
Oh, like a threshold.
A threshold.
Yeah.
And you end up with 2 or 3%
Yeah.
difference.
Yeah.
And it breaks the country.
Yeah.
So Trump did not win by a big margin.
Yeah, it wasn't that big. Yeah.
And how is that going to affect the future of the dynamic American economy that pulls in the best brains on the planet to boost? It's not Americans. I mean, what's his name was right. He says Americans are too dumb. We need to get these Indians.
Well, there's a visa program called H-1B.
Golden visa, whatever.
Yeah, they have an H-1B visa program. 65,000 people are let in each year. A lot of them from the Indian subcontinent to work in the technology sector. So they haven't said anything about that program, but I'm sure it's
He was kicked out.
sure it's
He
in.
was kicked out of the group. He
Yeah,
said it.
yeah.
The Indian, what's his name?
Vaswamy, who's also co-head of Doge.
Yeah, he was the guy who made that comment, right? So
Yeah.
America's moving into a situation
Yeah.
geopolitically.
Well, it's
not just
inflationary.
Locally, run by technocrats.
Yeah.
Run by, that's by
Autocrats.
no, technocrats.
Yeah.
The likes of us, why these people? They think they can run.
Yeah.
That is a big problem.
Yeah.
Is that takes the dynamism that America's pulled from the rest of the world, the best minds on the planet, to build these companies up. Like Tesla, though I think it shouldn't be in the top 5 minutes.
Yeah. No, I agree. And it's
might
inflationary.
change. I mean, I understand your point that over time you get that 7%. Yeah. America's always picked the best. It always had. It would burn capital. It would burn industries when they went right.
Yeah.
What was happening is very different.
Yeah. Well, I suppose we're getting into that whole discussion about immigration enriching countries, particularly high-skilled immigration. I think it's a risk. I think it's a risk.
China's putting its own and others.
Yeah. Yeah.
So
well, I think they've set up a deep undocumented migrant register as well now, haven't they? But I think the immediate effects, so you can make the argument that productivity is going to be affected long run, growth will be affected long run potentially. But bear in mind, we've only got another 46 months to go. So this may not last. This too will pass. Yeah, 3 days, 5 hours. Yeah.
Something very significantly different about it is that they're running scared.
Yeah.
And like Brexit, everyone's paralyzed to know they can't even talk about it.
Yeah.
Democrats
Well,
don't know
Brexit.
how to do it.
I mean, we're sort of running out of time, and I'll talk to you separately about it. But the one, again, hope not despair, certainly on Brexit, is the narrative about Europe defence spending, the leadership Starmer. I mean, not a massive fan of Keir Starmer, but he has shown leadership over the last couple of weeks. I think everyone can probably agree on that. I think it's possible that a conversation about Europe could be reopened in this country. If you look at Farage's blog post on the Zelensky video, he wasn't automatically supporting Trump. It was quite interesting. I can't remember the exact words he used, but he was saying this is not. I think it was something like this is not acceptable. So, you know, if the British right stops obsessing with America, you know, this wide-eyed Atlanticism that we've had for so many years in this country, and actually starts thinking about the continent we're actually in, then I think there could be change. I think Trump could unwittingly ignite that.
I don't know. Trump's got to stop everything in the air.
Yeah.
Some things, as you point out, need to be changed, like in certain regulations, but not all the EPA.
Yeah. Yeah.
Or all these other all the good stuff. This
Yeah.
is just chaos.
Yeah. No, I would agree.
And for me, I'm just thinking, maybe the world will end up in a better place without, because I see America.
Well,
as
maybe
dangerous
people will tire of
evil
this.
enterprises.
Maybe it takes this. Yeah.
A bit warmer. Yeah.
But maybe the more chaotic the better, because then people will tire of it all the faster. And I think if you look at Britain, it's had its populist experiment, and yeah, the consequences we're living with. But you know, Britain in a way has emerged out of that sooner than the rest of Europe. Anyway,
Yeah.
on that, I'm just conscious that we're running out of time. Yeah, sure.
For China and Europe, a couple of sectors you would suggest that might be tactically
Um, China, probably the technology sector, looks the most interesting. The integration of cheaper AI into technology, the rehabilitation of Jack Ma, I think, is helpful. So I think that's quite an interesting area. In Europe, if you look at Germany, the sectors that have been outperforming have not been the kind of heavy industry, kind of industrial champions. It's been more Zalando, Adidas, kind of services, more services-based, consumer-based than necessarily, although Volkswagen has done okay in the last couple of months. But I think there is another part of the German market which is also doing well, as described. But even if you just look top down, you know, you could just buy the stock 600. You know, that's how we're invested. Just the MSCI Europe index, just being longer of that, you will capture it that way as well. It doesn't have to be too cute, basically. And again, that's our approach, is not to be too cute about these things. We look top down. It makes the portfolios simpler. You can see exactly what's going on. You know, if you get it right with the index, you will do well. So I think that's probably enough from me. Thank you very much, everyone.